Hi, good afternoon. Thank you for joining us for our next webinar with ALS Canada. We're just going to wait a quick minute and we'll do introductions and get going on our presentation. So as we see people joining, we're going to go through a few housekeeping things. Just a reminder that we are recording this webinar, so if you're not able to attend the entire thing, you'll be able to access it after. And our host presenter for today has offered to connect with people, and his information will be on the screen after. So I think I'm going to do introductions. ALS Canada would very much like to welcome Lamb to present to us today on managing your finances while dealing with ALS and COVID. Doug is a long time, we'll call friend, supporter. He goes back way back within our organization. Previously, he actually was a director and treasurer of the board of directors for ALS Canada, or ALS Ontario and ALS Toronto. So before we were ALS Canada, so going back quite a bit, he has graciously given his time to our organization. Doug is a chartered accountant, a certified financial planner, an elder planning counselor, and he also holds an MBA. You have a lot of things behind your name, Doug.
Thank you.
So I'm actually going to go ahead and just hand the presentation over to Doug. And then if you have any questions, as regular, if you're new to this session, you can post them in the chat box. And at the end of the presentation, we will be taking some time to go over those questions with Doug and make sure everybody has an answer to everything. So Doug, I'm going to let you take it away.
Thank you very much, and welcome to all the attendees. I hope you can see the screen there where I have my slides prepared. We also can send out a copy of these slides if you request them. So as an overview to the presentation, there's going to be an introduction. We're going to talk about the need and value of financial planning, and talk a little bit about why so few people have plans, and then look at what are the normal plan components. And they would be a financial plan, an estate plan, a risk plan, an investment plan, and a tax plan. And then look at some of the impacts that COVID brings us, and also some of the special medical need impacts on the planning. So I'm going to talk about planning in a very general sense, and because I think the COVID and the medical aspects really fit into any normal plan. It's just you have to appreciate how that's done. So we're going to look at a number of different things today, and hopefully people will leave knowing a little bit more about financial planning, because financial planning is something that a lot of people talk about and very few people really understand. And the reason for that is that many of the people who provide it either provide it on a very limited basis as they're trying to sell you some investments, or else on a very detailed basis, and it's really, really expensive. By the way, I have nothing to sell today or in the future. I do this as a voluntary thing. I just want to make that very clear. So we're going to move along. So I was introduced. Yes, I am a chartered accountant. I am a certified financial planner, which is really the gold standard in financial planning in Canada. I'm an elder planning counselor. I hold that designation. It deals with people who are, I'm not sure how you define elder, but sort of the older generation. And I also have an MBA. I worked for many years as a financial advisor, providing financial planning and investment advice to my clients. I am generally retired from that now, so that's why I say I have nothing really to sell. I also served as a board member and treasurer of ALS Ontario and ALS Toronto. My father-in-law had ALS, and he was the one who got me involved in the ALS, and that's where sort of my link to getting into the ALS community with him, and also through my volunteer work there. So I'm going to start with a general overview of managing finances, and then, as I said, I'm going to follow with the issues that are raised by COVID and with ALS. So studies have found that individuals who plan feel more than twice as good about their long-term financial health, their emotional well-being, their ability to achieve life goals. In spite of this, many people do not have the peace of mind and comfort of a financial plan. So what do we mean by those particular topics? Well, the financial well-being is when someone would be categorized by, I feel prepared in the event of an emergency. I feel prepared to manage through tough economic times. If something happened to me, would those close to me, those I care about, be financially okay? Am I on track to reach my desired lifestyle retirement? I have peace of mind. Or over the last 5 years, I've improved my ability to save. They would be the sort of the benchmarks for dealing with financial well-being. When the emotional well-being is when someone says, I feel I barely get by every month, or I don't know what to do to improve my situation, or I worry a lot about my financial situation. That's how they're measuring the emotional well-being. And then the last part is achieving life goals, and say making sure there's enough money for kids' education, helping kids perhaps with some major purchases, retiring in a lifestyle that you'd want, being able to take the vacation you want, whether it's each year or periodically, and having sufficient discretionary income to lead the life you want, and generally retiring in the lifestyle that you want to. So these are the measurements that people are twice as well off when they plan. And so you would want to say, why do so few people have plans? And I think the reasons are that people don't always understanding the planning process or its value. I think they become intimidated by financial planning, or maybe intimidated by the financial planners. They think it's time consuming and costly, and they don't know where to turn for the planning services. And as I said before, many of you may deal with a financial planner and a financial advisor, whatever the term they use, and many times they just go through a bunch of questions, and then they go ahead and they want to invest your money, and they make their money off your investments, and they don't really do a detailed job on the planning. And frankly, they don't have the tools to do it, most of them. I'm sure they'd like to, but they don't have the tools, and really where they're making their money is on the investment side. There are some people some advisors who do planning only, and they're usually very detailed and very expensive. So what is planning? Planning really is made up of these 5 different plans. There's a central plan called a financial plan, and we'll look at that. And then this financial plan is supported by 4 plans: a tax plan, an estate plan, an investment plan, and a risk plan. So that's kind of the overview of it. So what are these things? So a financial plan is something it's like a retirement plan. It uses very conservative assumptions, and they'll start off and they'll develop and document your financial and other life goals. Then you will look at your current assets and liabilities. So that's, what are your investments like, your investment in your house and stock market and so on, and what kind of money you owe, and that would include mortgages and other liabilities. And then you would look at your current income and expenses, and that's really like a household budget, like what money's coming in right now and what money's going out. And now we get into something that's really key, and I really want to highlight, is to determine any changes between now and retirement. And I know this is not a retirement presentation, but I want you to understand that there are 2 phases. It's where you are now, going to retirement, and then after retirement. So you want to be able to determine what changes you might have between now and retirement, and you want to reflect in your goals and your lifestyle objectives now, and also during the different stages of retirement. And that's what the financial plan has. So when we look about different stages of retirement, we'll look at that on another slide. But when people retire, may have a very active stage. They may have a less active stage. They may have a seniors environment stage, and they may have a nursing home stage. But you need to look at what your objectives are and what the costs might be for these different stages. And then you want to evaluate the plan. And to evaluate this financial plan, it's really quite simple. It's, can you afford to do it? How long will your money last? And that is the sort of the bottom line for that. So the major questions that you want to address is that prior to retirement, you want to look at what we call discretionary expenses. They're expenses that are not fixed. They're ones that you can do with or do without, or you can adjust a little bit. And then changes in income. So you want to look at those to see how they can be changed, because if your plan works out as to how long is my money going to last you, and it lasts you or runs out too early, then you need to go and look at, can you change some of these expenses right now? Are there room for additional income, whether it's a part-time job, if you're not working, if one person's not working, or taking a second job or something. And in retirement, the questions become, can I retire? At what age? What lifestyle can I support? Again, how long will my money last? And you need to evaluate that plan. And I think the plan has to last you a long, long time. I think that's something that's paramount in this whole presentation. And if it doesn't last you long enough, then you have to go back and say, can I retire? What if I work another couple of years? What if I reduce some expenses? What if I take one trip when I'm retired rather than 2 trips? Or maybe prior to retirement, are there some changes I can make so that you have a plan that is that's realistic, and it results in your money lasting you a reasonable length of time. So as I say here, an acceptable plan will incorporate all the financial and other life goals and have money last you long enough. And if it doesn't happen, different assumptions can be made and the plan results looked at again. You can save more, spend less, you can work longer, you can work part-time, you can adjust your retirement expenses. So that was the retirement plan. Now we look at estate planning. And this is something that also I'm sure you've had presentations on before, but I'd like to go through. On someone's passing, an estate can be divided up between 3 groups of people: your beneficiaries, charities, and the government. And with the government, they have what they call a probate tax, and there are income taxes that would be on someone's estate. And that's where planning comes into account, into view, where you can actually do some planning to reduce or eliminate some of the probate and some of the income tax. So that's a really good thing to talk about with your advisor, how you manage those 2 tax items. And so that you can manage. You can also decide on, after that money has been paid out, how much you'd like to give to charities, and then how much you'd like to give to different beneficiaries. The tools within your estate planning are wills and powers of attorney. So a will is a document that names an executor. That's someone who looks after your will to distribute your assets according to your wishes. But in the absence of a will, the distribution is made according to a formula. And about 50% of people don't have wills, and their money can be divided amongst people, maybe not in the way that they would like it to be done. So it's really important for people to have a will, and you can handwrite something, I guess, and get it witnessed. You can go to the internet and get some forms and fill it out, or you can actually go to a lawyer and have it done properly. I recommend you spend a few dollars and have a lawyer draft up that will to make sure it's done correctly. And in that will, if you're a little bit younger and you have underage children, one of the important issues will be the guardian. Who would be guardian for your children? And I think it's important that you pick someone who is going to be age appropriate. It's going to be have the same kind of values you would have. And also they would be willing to take on that job. That's both a big undertaking emotionally for someone to do that, but also can be financially. And I think if you are selecting a guardian, you want to be able to provide to them the planning you've done around that, and say, if you consent to be a guardian for our children, this is the kind of financial resources that would be available for you, because you wouldn't want that guardian who might also have children to find by taking your children on it really financially undermines the viability of their own situation. And also, one of the things that you have in a will is you have the executor who will look after the administration of the will. And for that, you want someone who is capable of doing it. They have to be willing to do it. They have to be able to do it. Often they will get some assistance from a financial advisor. I know when I was back in working full time, I helped clients, assisted them in the execution of the will. But you want someone who is ready, willing, and able to do that. There's also powers of attorney for property and for healthcare, and that really means that you're giving someone else the ability to make decisions for you. It's a substitute decision-making tool when you're unable to make your own decisions. So for property, it would mean making financial decisions, and I think you want to be make sure that it's somebody who is able to do it and understands it. If you've got a number of people who might have an interest in your finances, you want to make sure that the person who's doing it is viewed as honest and capable, and is going to make the kind of decisions that you would make. You can have a power of attorney that's a general one, that's open, that can be exercised at any time, or you can have ones that are only become valid if you lack capacity or you're not able to make those decisions on your own. Having a general one can be a little bit dangerous, because if someone has it, they could go ahead and make some decisions without even asking you. So that can be a issue to think about. But also, if you have to prove that you don't have capacity, or you're not able to deal with them on your own, that may take some time before someone actually makes that formal assessment. You might have more than one attorney. I suggest you have an odd number, so that if they're taking a vote, majority is going to rule. So you want people who can get along and look after those kinds of issues. When it comes to the healthcare ones, I'm sure a lot of you have been thinking about this and dealing with it. And what they're really doing is you're giving someone the ability to make decisions for you with regards to your care. And it's important that you talk to those people and make sure that your intentions and your wishes are really well known by them, and that they understand that they're making the decisions that you would make, not necessarily what they would make, but what you would make. I've seen times when there are some difficult decisions that people don't want to make about their parents, say. But if you say, well, what would mom or dad do? They say, well, they would follow what the wishes are without any problem. So I think you need to go over those wishes with them, as painful as those discussions can be, and give them the permission to follow your wishes. I think it's really important to do that. Now we look at tax planning, and this we don't have to go into a huge amount of detail, but there's current planning, and then there's retirement planning. So in the current planning, I would be suggesting that you maximize deductions and tax credits, and you can do that by looking stuff up on the internet. You can talk to your financial advisor, you can talk to the person who does your tax returns, and just making sure that you've got those things in place. You may have disability tax credits available to you. You may have medical expenses that need to be kept track of. You may get certain credits for doing home renovations and different things like that. So you just need to know what's available to you and make sure that you're taking advantage of those things. You also want some tax efficient investing, and basically that's part of what your investment advisor is going to help you with. Some type of income like interest and so on is fully taxable, and there's capital gains income where the income is only taxed at half the rates. So planning your to pay the minimum amount of tax can be really important to your cash flow. You can also use the TFSA or a tax-free savings account. That's where you're allowed to add a certain amount to that account every year, and that amount of money, when you take it out, even though there's growth in it, is never taxable. You also can have RRSPs where I guess most people are a little bit more familiar with, where you can get deductions from your income. It goes into an RSP, and then that money, when it's taken out, is fully taxable. Where it's a little bit trickier is in retirement. You have to look at, well, what's the best way to take my money out of my RSP? Because at a certain age, your RSP turns into a RIF. They're really the same thing, except that at age 71, they have to go into a RIF. And when the money comes out, you want to make sure that you're taking the right amount of money out to fund your retirement. And you have to look at other sources of income and make sure that you don't take out too much in any given year, because one of the things that can happen is that if you're drawing your old age security, or your old age security clawback comes in, that over, I think it's about 78,000 changes every year, they start clawing that back. So having the right strategy for taking out your RIF money versus money out of non-registered accounts versus maybe money out of a tax-free savings account, there are a lot of things at play, and I think it's really important that you get some good advice around your tax planning, whether it's your current planning or it's your retirement planning. Now, there's a risk plan, and this is where people like to look at and identify and quantify the risks of death, disability, incurring a critical illness, the early onset of a debilitating disease, and also the risk of running out of money. You need to talk about those risks, how they would impact you, and how they would impact your plan. So once you have a plan, you need to look at and almost do a fire drill and say, what would happen if this happened? What would happen if that happened? And how do you mitigate these risks? And basically that's sort of stress testing your plan. The risks to plan achievement in the risk plan, a lot of these strategies to manage these risks involve insurance products. And if your advisor is also life licensed for insurance products, you need to talk to them about what does, here are the risks, these are the solutions that work, how much does that cost, and how can they be evaluated and incorporated into your household budgets and run your plan again. And I've had people who say, I can't afford to have, the right amount of insurance for a particular reason, and I'm taking, 2 trips or 3 trips a year, vacation trips, and basically you just go back and say, if you cut 1 trip out, that's going to make sure that you have your risks covered off with an insurance type product. So it's getting someone together and identifying the risks, figuring out what the costs are to mitigate those risks, put those numbers into your plan, and see what happens. Now we get into the investment plan, which you people might be a little bit more familiar with, and I hope I'm not going to bore people too much with some of the details, but it's really important for people to understand their investments. I know back when I was doing investment advice, a lot of people would come in and they really didn't have a clue about their investments. They just sign here, sign there, but it's really important that you have a pretty good understanding, even if it's sort of from a high level. So we want to develop and understand your investment profile. You want to see if the risk is appropriate in your investments and that you're properly diversified. And then the risks and the returns and the role that this plays in your plan. So if you've got money that's invested, it goes into what they call a portfolio. And how is it structured and why is it structured that particular way? So in general, portfolios are broken up between fixed income component and an equities component. And the fixed income component can be made up of term deposits and GICs and bonds. They have lower volatility, but lower growth potential. The equities, on the other hand, are shares in companies, and they have higher long-term growth potential, but are more subject to volatility. Sometimes people think that term deposits are your safest investments. And I would argue that a term deposit is not a very safe investment because you're not getting any protection from inflation. And usually if you have something in a term deposit, by the time you pay tax on the income and inflation, you're behind the game. So you want to have the right amount of fixed income for your protection. And you want some equities. Actually, the protection for the fixed income is going to be protection on markets going up and down. But the equities is going to protect you in the long term from inflation. So there are a number of issues that relate to risk. The first one is there enough money protected through fixed income, whereby the risk of selling at a loss is addressed? It's very simple, that markets go up and markets go down. And since the beginning of time and through the Great Depression and through the financial meltdown in 2008, the markets do come back. The problem is if you have to sell something when it's at a loss. And so what you want to do is to make sure that you have enough money protected. It's making you a little bit of money, but it's not going to go way up. It's not going to go way down, so that when you're taking money out, or if you need to sell something to get some money, you're not selling at a loss. That's the important thing. But the second issue relates to having enough money that's not in fixed income, but in the equity section that's going to protect you in the long term. And they also have to be diversified. They have to be diversification within the fixed income portion and the equity portions. So what's diversity in the fixed income? You've got term deposits, GICs, government bonds, corporate bonds, high yield bonds. You've got these type of instruments in different countries and different currencies and different qualities. And the further you go down this food chain, the higher the returns might be, but the higher their risk. So within your fixed income, you got to have good quality stuff, and you have to understand just how good that is and what the risks are and what the potential returns are. On the equity side, the growth portion, you need to understand, I think, the kinds of companies that you're investing in, whether they're big companies, mid-sized companies, or small companies. The larger companies are probably lower returns, lower volatility, mid-cap, a little bit more potential for returns, a little bit more potential for volatility. But then your small cap, or the smaller companies, the startups, the newer companies, they will have larger returns, but larger volatility. And then you have investment style. You have investment style where you're based on value, you're based on growth, or a blend of the two. Value and growth are different investment styles, and any one of those can be in favor at a particular time. And I think what you want is a good representation of all the investment styles. You also want to look at how your money is invested geographically. Right now the biggest market in the world and the one with the most growth recently is in the U.S. I don't know that might not be as important today, having money in the U.S., as it might be in a couple of years. I think they're going to be paying a big price for this COVID, and a lot of other sins that they've incurred. I think there's probably some stuff in the Far East that over time is going to prove on a longer term basis to be good investments. But you need to look at and see where your money is invested geographically. You don't want to be 100% in Canada. I mean, that's just, a lot of people will do that, and it's just not the thing to do. I think Canada is, 3 or 4% of the world, economic situation. And you can't have like 50, 60% of your money in Canada. You need to be invested geographically according to where the potential is. And then you want to look at underlying industries. There was a time when, something hot might be in the technology industry. And then that really, I think it was in the year 2000, it really went in the dumpster and people lost a lot of money. But you need to have a good cross-section and a good amount of diversification along the underlying industries. But you need to know. So when someone's investing your money, you need to ask the questions about how is my money invested in the different company sizes, the different investment styles geographically in the underlying industries. So what are the implications when it comes to COVID? Well, it's really, there are changes to income and there are changes to expenses. So the changes to income may be that some people are out of work, either temporarily or permanently. That needs to be reflected, whether they're not retired and it's an adjustment pre-retirement, or it's in retirement and it's an adjustment. But you need to reflect in your planning changes to income, whether they're temporary or permanent. Also changes to expenses. In many cases, the expenses may be less. People are quarantining right now, and they're not traveling, they're not entertaining, they're not going out for dinner as much, they're not buying as many clothes, not traveling, car expense wise, and so on. But you need to take the implications of COVID and reflect them in just the normal planning practices, where you change things that are happening on a daily basis. And so you might want to be very conservative in those things and say, what does that mean? Does that mean I have to work longer? Does that mean my money won't last as long, or what have you? When it comes to special medical needs, I think there are sort of three categories that we can look at. And one is sort of immediate needs. If somebody has a diagnosis that means that they need some immediate equipment, they need changes to their house, they need adaptations to their car, different things like that. So you need to look at what are the immediate needs. There may be some midterm needs, which could be similar to the immediate needs, but on a growing basis. And then there's just some longer term needs. So the immediate needs, again, could be changes in income, could be changes in expenses. It could be one-time housing or other costs. The midterm issues could be exactly the same thing. It could be changes in income, expenses, one-time housing, and other costs. But you need to put these down on paper, and they need to be incorporated in your plan. The longer-term issues, really, on a long-term basis, is given all these changes, how long will my money last? So that it sort of goes through the main part of the planning or the presentation. And I guess as a takeaway, I'd like to let people think about that planning is valuable. You look at all the aspects of how they value planning, and people are twice as happy. They're twice as well off by planning. But you have to find a suitable advisor who's going to do that, who's really going to connect with you and provide you with the kind of services that you want to do that. And I would say take charge of your finances today and have a peace of mind of an achievable plan to meet your financial and other life goals. And what I've tried to do is talk about the general planning situation as it would be to any person or household. And within that, there are always changes that are made immediately. I'm going to say now, up until retirement, and then after retirement. And that the things that are sort of facing us today, whether it's COVID or whether it's ALS, is that those changes need to be incorporated into your plan so that you can see how your money's going to last you in the short, mid, and long term and what those impacts are. I'm able to provide planning services. I do it on a pro bono basis to qualified people, and I'd ask you to reach out to your regional manager for more information about that. If you have questions of me, this is my email address. It's lamb_doug@hotmail.com. I will answer those questions to the best of my ability as quickly as I can. I hope that no question is a stupid question. Sometimes it's a stupidity. It's not asking the question. These are questions that are important to you. I think they're important to in the ALS community. They're very important to the patients. I think they're very important to the patients' partners. I think there are sometimes tough discussions. But anyways, any way I can help, I would be very glad to help. So with that, I think I'm said all that I'm able to say.
So thank you, Doug. We have some questions if we're able to take those.
Sure.
We're flying in through the presentation. So, and if we can't answer these questions, we'll have Doug get back to us with the answers,
Yep.
Or you can reach out to him directly. But there was a question if you could explain a little bit more about disability claims and orphan benefits.
And orphan benefits?
Yes.
Benefits to an orphan?
Yes. That's all I got in terms of the context of the question. I'm thinking he wants to know a little bit more about what does that mean?
Well, the disability claims is that that when people there's a disability tax credit that's available to people, and they need to go to a doctor. There's a form that's filled out, and then it's registered with Canada Revenue Agency, and then they can when they file their tax returns, they get a disability tax credit, and they qualify if the doctor fills it out. Okay, so they're the kinds of that's the disability tax planning that you can get. But you also have like general medical expenses that you need to talk to whoever is going to file your tax returns for you as to what sorts of things qualify and what sort of backup you need to give them to make sure you're taking advantage of the medical expenses. There may also be, and something that I'm not all that familiar with, is that there are times when you can make some changes structurally to your house, and there used to be some incentives for some of that. Quite honestly, this is not something that I deal a lot with, but I think you could look into it if you had to make major changes. But the orphan one is sort of, is that the benefits to an orphan? I don't.
Maybe we could get that person to expand on their question while we ask some of the other ones.
Okay.
I think that so someone just asked what can be claimed on a disability tax credit, and I think that person actually has two separate asks. And the one being the disability tax credit, which you mentioned already, that is filled out by the doctor, filed with the CRA, and that stays on that person's file. And that credit automatically occurs within the CRA when the person files their taxes.
Correct.
The other side of the question is what can be claimed on the disability, what can be claimed under that? And that would be under medical expenses. Is that correct?
That's correct.
So things like, I know if you live a specific distance from the hospital and you have medical appointments and it's further than a certain number of kilometers, that you could keep those receipts, those parking receipts. Yes. If you live, for example, in a northern area and you have to travel to, for example, Toronto, you would apply for that credit, and there is a standard amount that you would be given every time you have a doctor's appointment in Toronto. Right. And then, so the other things we know of that people would claim on there is anything around house modifications could go under their medical expenses that they were prescribed by a physician. Right. Or modifying their house, things like a TENS, medication that's not covered. They would keep all those receipts basically. Is that
correct?
And then whoever is filing their taxes would then review those with them and determine what they're eligible for.
Correct.
So the next question is around life insurance policies. And so the question is, and this is specifically for someone who's living with ALS, does the cost outweigh the benefit to the family to have a life insurance policy? And I'm making an assumption here that this is not a pre-existing policy. So can someone with ALS qualify for a life insurance policy after a diagnosis?
Okay, so you're not talking about existing coverage.
Well, I would assume if you have existing coverage, you would just use the same policy you had. You wouldn't necessarily buy new policies.
Yes, I can tell you a story on existing coverage, and I was visiting an ALS family. It's a few years ago. It was right around Halloween. I remember it like it happened the other day. And the husband who had ALS was out, and I was just dealing with the wife at that time. And I said, just what sort of insurance coverage do you have? And she said, oh, we have this policy, but I just canceled it. And I said, what? You just canceled it? That's very interesting. How did you cancel it? She said, well, I made a phone call. I said, well, they have to have something in writing, but think about this. If you have existing coverage and the person has has ALS, you want to keep that existing coverage for sure. Because your second question is, can you get it? And the answer is no. You can't get regular insurance with that type of diagnosis. However, there are some guaranteed life insurance policies where regardless of your health condition, they will issue you a policy. But if there's an event happening within 24 months, you get your premiums back. You don't get the coverage on the policy. If you took it out and nothing happened for at least 24 months, then you would have a policy. The policies are usually, the maximum might be $25,000. So it's a relatively small amount, but there might be 3 or 4 issuers of that. So you could do it 3 or 4 times. I think you can actually go online, you get a quote, whether that's $160, $170, $200 a month for $25,000 of coverage, but you cannot claim on that for 24 months.
So if the person was to pass away within that 24-month time, they would get their premiums back.
Get the premiums back. I think there's one I saw where you would get the premiums plus 15%, but basically, yeah, you can't. That's just what they all have, and all the banks have them. Motor League has them. There are all kinds of people who have these guaranteed life insurance policies, relatively low coverage, fairly expensive, but if you took them out and there wasn't a claim for 24 months, then the full amount of the 24 grand or $25,000 would be available.
So if you do the math on that, you're paying $5,000 that if you may need that money in advance, it may be better to spend that money month to month versus putting that into the policy.
Well, let's just say it's a $200 premium. That's $2,400 in a year. So and if it's after 2 years, it's $4,800, but the payback is $25,000.
Okay.
So it depends. My father-in-law had ALS. He had ALS for 22 years. It wouldn't have been a good thing for him. But for people who have a shorter time frame or a shorter outlook, it's kind of a relatively low risk to look at one of these, because you get you're not gambling your premiums. I guess you're gambling the returns or the interest you might make on your premiums, but that's all you're gambling.
Okay. So the next question is it better to take CPP if you have a life expectancy? And I guess my question would be going back to that individual to say, is this for someone who's at the age of retirement?
So the question is, should you take CPP or wait a couple of years? Is that the question?
Yes, but for anyone who is still working with ALS, they would have gone off on CPP disability.
It becomes a very simple question. I used to get it all the time with people who do not have the disease, and it was very simple. And I would say to them, it's all around longevity. If you think and it's usually about age, I'm going to say age 74. If you think you're going to live past age 74, wait. If you don't think you're going to last past age 74, take it. Someone with ALS, take it.
Is there, in terms of investment philosophy, when it comes to people living with ALS, is it different than a typical investment strategy?
It's it can be, because what you want to do is you want to have enough money protected in your fixed income where it's not going up and down, that you can draw on should you need the money, and you don't want to be selling at a loss. So that in general, if your short-term and mid-term needs for money are going to be high, you don't want to be risking that in equities where the money could be down, 10 or 15% when you need it. So you might have a little bit more in the safety component for that. But if you have a partner, you also want to make sure that you've got enough money in the growth stuff, protecting a partner or a spouse from making sure that there's growth for them, because it's what's gonna be like for them, So it's very individual. You got to make sure that you've got enough money that's protected for your short-term, mid-term needs.
So is there anything in terms of people living with ALS that, in terms of government subsidies that you're aware of have occurred during COVID?
No, not that I'm aware of.
So for the person asking the question, we are aware, ALS Canada is aware that if you had filed a disability tax credit with the CRA before sometime in September, you would qualify for the additional $600 fund. And so I know that that's been paid out just recently to our clients, right, who have filed that. Right. So if you haven't, then you need to be reaching out. If you haven't received that money, you need to reach out to the CRA to ensure if you've completed the disability tax credit. And that's a very typical document that is completed within most clinic settings upon diagnosis. That form is completed. Next question is, and I'm having a hard time trying to understand this, how can we plan the patient part for what ALS has for us in the future? And
sorry, could you repeat that?
The question is, how can we plan the patient part for what ALS has in the future? So I'm just wondering if the question they're asking is more about the costs associated with the possible increased amount of cost that would be short term.
Yeah, that's one that I think they need to find some resources around people, whether it's, you used to have your equipment inventory where you were lending out to people. Someone has to sit down and say, well, with your counselors there and your regional managers, whoever is advising, what are the expectations in terms of resources that I'm going to need? But that's the tough part. It's the tough part in any planning exercise. And then those numbers get plugged into your plan. But coming up with the numbers is the tough part. And I guess it's between your medical staff and people on your staff or what have you to make those estimates.
So I think that it's really important that people realize that you have to look at, and one of the most significant costs people do make living with ALS is around equipment. Obviously, we do have our equipment loan pool, and that helps provide a lot of things for people. But there is things that we just don't provide. We just don't have the resources to. And a lot of those are around home modifications. Right. And I think that's probably, for some people, there's a belief that this is when they're diagnosed with ALS, they choose to say, well, I don't need to do it yet. and they wait for a longer period of time, others have to then do it the opposite, doing it immediate. So I guess that's where Doug's saying you have to plan your short and long-term costs associated with living with this disease, because we don't know what they're going to be. There also is a possibility that we know significant number of people can't afford those resources. And
Right.
so what do we do with what you have? And how can we modify, if we can't, if spending $16,000 on a curved stair glide is just not a feasible option for somebody, what are the second best options?
Right.
And that if that's not a cost you can incur, then what do we need to do to make a change to your location to make it as accessible as possible?
Right.
And it might not be a financial thing. For some people, I think the discussion around financial investment is, what are the immediate things I have to do right now? That's all I can think about. And other people are thinking about, well, I could be living with this disease for a really long time. And for some of those people who've been living with ALS for more than 5 years, their priorities might change in those conversations with somebody like you.
Yes, I think the advantage of planning might be, yes, you've got a $16,000 requirement, and I'm sure you could sell investments and come up with 16 grand. But the trade-off for that might be quite an impact for a survivor or someone else, or for more needed expenses in later stages. You know what I'm saying?
Yeah.
So it's not always. I think the medical people will give patient advice on what's appropriate and what's possible, but a financial plan can kind of give you the financial implications of doing it or not doing it.
It's like when people get to diagnosis of ALS and their first instinct is to sell their house. And always a discussion of, you need to have multiple discussions with multiple people, including your real estate, including your financial planner, including your family, to make these decisions, because it's not as let's just sell our house and move somewhere accessible. The long-term repercussions of that decision, that might be a short-term decision, like you said, but there might be a long-term repercussion to that decision.
Absolutely, 100%. And it's, the people that you're addressing, the stakeholders that you're addressing in this financial planning aspect are the patient, but also the partner. And people worry about, if you're the patient, you're worried about how the partner might be left long term, and the partner might be quite worried as well. And so that's why if you have an independent planning person, they can give you some feedback on, yeah, you can do this. You could take that trip around the world, but this is what it's going to do to your plan. Or you could make that renovation at different levels. They can give you the long-term financial impact of these different decisions. That's where the financial planning can come into. I can't help with whether you need this or that to make it a house more accessible. That's someone else's expertise. I can help with what's the financial impact of taking option A or option B.
One of the next questions we had was, do you know the percentage of how much is, when you claim medical expenses on your taxes, how much is, what's the percentage in the return?
Even in my practice, I didn't do a lot of tax returns. I used to tell people to get their own tax preparer, but usually you don't deduct the expenses out. The medical expenses come as a tax credit, and it's usually basically as a deduction at the lowest tax rate. So it's not a huge deduction, but it is a deduction. Okay. So it would be your lowest tax rate that you're getting the benefit of that. You're not getting it off the top. If you deduct an RSP contribution, it comes off the top, but when it becomes a tax credit, you get the medical expenses, and then it's turned into a tax credit based on the lowest tax rate.
So this one, I have no idea what this even means, so maybe you'll be able to explain this. What do you think about investing cryptocurrency?
I think there are a number of things that I would stay away from. Anything that you don't really understand, stay away from. And I don't understand that. I mean, I can regurgitate what people say about it, but it's a newfound currency that I mean, it's like a house of cards. I mean, you don't know what's behind it. It's not like it's the government of Canada backing a currency, or the U.S. Treasury is backing a currency. It's gambling, in my mind. You might get lucky. You're very unlucky too.
Great. So I think that's all the questions we've had. They've been coming in quite quickly. So Doug has left his email address up on the screen.
I was surprised there was no questions about Questrade and how you can save all these fees and so on. I was expecting that. But
do you want to explain that?
Well, it gets under my skin every time I see these TV commercials where they say, well, we're 2% per year, we're saving, and that's $100,000 and so on. I can tell you this, that the last time I saw an analysis, the Questrade portfolios, there were 6 of them, and they compared them to 6 portfolios with one company. I believe it was Fidelity. And the Fidelity portfolios outperform fairly significantly every Questrade portfolio in every category, even though they paid a little more fees. And that's because the fees are used to pay people to manage your money on an active basis. And so saving all this money on fees, yeah, you pay less fees, but you don't make nearly as much money. It just makes me crazy to see these ads, because it's the conclusions they're drawing are wrong in my mind. So anyways.
I think some of the questions that came out of today would be a good opportunity for us to connect through the Service Ontario as well, to get connected with them to help people more around disability tax credits and things like CPP disability, old age security benefits. It might be an option for us to kind of pursue that as one of our webinars.
Yeah, and I think if you're talking about the CPP disability, that maybe I missed that particular part of the question. There are some things there, and I think you need to talk in detail about qualifying for that with your financial advisor. And your tax preparer is going to tell you all the credit. I mean, a good one's going to give you all the tax credits and deductions that are available to you, and you just make sure you're taking advantage of them.
Thank you so much, Doug, for taking today to speak to us. And I really just want to thank everybody else for joining us for our last webinar of 2020. We will be doing more in January of 2021, but we just wanted to take this time to thank everyone. We've had some great responses, and we just appreciate everybody taking the time to join us. Doug, thank you so much for taking the time this afternoon to speak to us and give us some information. And I found it extremely helpful, although very confusing for someone who has no background in this. So I think taking the opportunity to, if someone is really interested, to reach out to us so that we can connect you with Doug if you really have some serious inquiries, that we'd be happy to make sure that connection happens.
Yeah, I hope it wasn't too confusing for people. My main intent was to let people know that the planning process is a very valuable one. It's a very structured one, and people who have issues around COVID, around ALS, fit into the standard procedures. But you do need the information that's accurate to go into it. And just find a good advisor who can do that for you, and then you've got some peace of mind.
Yes, thank you so much, Doug. Thank you, everyone. Have a wonderful day. Thanks,
Okay.
Doug.
Bye-bye. Thank you.
Bye.